Friday was a big day for the bulls as stocks surged to multi-week highs. But here's the real question. Is this the start of a strong uptrend or just a dead cat bounce? If you're not familiar with this term, a dead cat bounce refers to a temporary rebound in the middle of a larger downtrend. It looks like a recovery, but in reality, the market might still be headed lower. And the challenge is, you can only confirm it in hindsight. But what if we could analyze the clues right now? Today, let's dive deep into market data, trends, and investor behavior to see what's really happening. To judge whether this rally has strength, we need to check volume and market participation. A real bull market starts when big investors, institutions and hedge funds, enter with high volume. Friday's volume was weaker than the previous day, which is a red flag for sustainability. But what about market breadth? Market breadth tells us how many stocks are participating in the rally. A strong market move happens when most sectors rise together rather than just a few big names. If only a handful of stocks, like Apple, Tesla, and Microsoft, are carrying the rally, that's not a great sign. But if we see strength across technology, industrials, consumer stocks, and financials, then the rally has stronger legs. One method traders use to confirm market trends is Investors Business Daily's follow-through day test. This rule says that if a major index gains at least 1.25% on high volume within 4 to 7 days after a market low, it signals a true uptrend. Friday's rally failed this test because volume was weak. That doesn't mean the rally is fake, but it does mean we need more confirmation. Not all rallies are created equal. If a rally is driven by defensive sectors like utilities and healthcare, it means investors are still playing it safe. But on Friday, growth stocks like Tesla, Palantir, and semiconductor companies led the charge. This suggests that risk appetite is increasing, which is a positive sign for bulls. Market psychology plays out in chart patterns, trend lines, and moving averages. The S&P 500 moved above its 200-day moving average, which is a bullish technical signal. But here's the catch. It failed to break above January's lows, which remains a key resistance level. Until we clear major resistance zones, the market remains vulnerable to another pullback. Some traders look for classic chart patterns like double bottoms, inverse head and shoulders, or trend line breakouts before they trust a rally. Right now, we don't have a clear pattern, which means we need more price action to confirm direction. One of the best signs of a market bottom is extreme fear. As legendary trader Brian Shannon says, bear markets either scare you out or wear you out. The VIX Volatility Index, often called the fear gauge, recently showed spikes in investor fear. At the same time, investor sentiment surveys, like the AAII Sentiment Survey, show extremely high bearish sentiment. And history tells us that bull markets are often born out of fear, not optimism. When most people are bearish, that's when markets tend to surprise to the upside. Apart from market indicators, we need to consider macro factors like inflation, interest rates, and Fed policy. The Federal Reserve plays a huge role in stock market movements. If the Fed continues to raise interest rates aggressively, that could put pressure on stocks. But if inflation data starts cooling off, the Fed might pause rate hikes, which could fuel a stronger rally. Right now, investors are closely watching the next inflation report and the Fed's policy statements. The market is at a critical juncture. On the bullish side, growth stocks are leading instead of defensive sectors. The S&P 500 broke above the 200-day moving average. Sentiment indicators show extreme fear, which can lead to a rebound. On the bearish side, Friday's volume was weak, failing the follow-through day test. The market still faces major technical resistance levels. Macro risks from the Fed and inflation remain uncertain. The best approach? Stay cautious but prepared. If the rally gains strength with higher volume, it could be the start of a bigger move. But if resistance holds, we might see another dip before a true recovery begins. So, is this the start of a new bull market or just another fake-out rally? The market doesn't give us clear answers right away, so we have to follow the data. Keep watching. Volume trends, sector leadership, key resistance and support levels, macro trends like inflation and interest rates. If you found this breakdown helpful, don't forget to like, share, and subscribe.